Rates are on the move again, and for a lot of people, that means there's massive opportunity to vastly improve their finances by refinancing their home mortgage. Problem is, life gets busy. Work, kids, all kinds of other stuff going on, and you neglect taking a look at and even having a simple conversation on, does refinance make sense for me? In today's video, I want to talk to you, like I've talked to thousands of other people, about different things to consider why it might be a reason to refinance. For a lot of people I talk to, they're paying tens of thousands of dollars in additional interest than they could or should be paying. And that breaks my heart. If you're willing to jump on the phone to spend or to save $15 or $20 a month on your phone bill or your DirecTV bill, do yourself the favor. Have the conversation around, am I in a position to improve my mortgage? Whether that's lower the interest rate or shorten the term or take cash out. There's a lot of different ways this can go. In this video, I'm going to share with you 7 different reasons why you may consider refinancing. And I'll talk to you about pros and cons and things that I've seen as someone who's been a mortgage broker for over a decade, and I've closed a few thousand loans. So this is not theory or guesses. This is real life scenarios and real numbers. So let's jump right into it. First and foremost, why a lot of people are going to think about or consider refinancing is lowering their interest rate. This is especially true in 2025 and 2026, as we've come off 3 years of relatively elevated rates compared to what we saw before. A lot of people that have a 6.75, a 7%, a 7.5. I've come across people that have an 8% mortgage rate. Lowering their interest rate to save them money is something that's going to drive you, and you're going to see advertisements everywhere about refinance to this rate. Now, I say this in a lot of videos. Everybody's scenario is unique based on your credit score, based on your loan type, based on how much you pay up front. So an advertised rate is really not worth the paper it's written on. You need to talk to somebody about your specific scenario. Me and my team would love to help. You can go to mtmg.com. You can connect with us. You can schedule a call. But no matter what you do, talk to somebody you like and trust. Lowering your interest rate, which in turn lowers your payment, can be something that truly benefits you. And that's the first one, is simply lowering your interest rate, reducing that monthly payment. What you also do, people don't talk about, is you change the amount that goes towards your principal every month. If you're paying a payment at an 8% interest rate and you refinance to a 5.99%, not only do you pay less per month, but of that payment you make every month, a larger portion goes towards principal, because the interest amount on 6% versus 8% is just lower. All right, number 2, and I'll glaze over this one quickly because this is less common, but you might be switching loan types. You might have an adjustable rate mortgage that's due to adjust, and you're like, I don't want that volatility. I want to refinance into a 30-year fixed. You might have purchased a home with an FHA loan, and now you're going to refinance into a conventional. Remove mortgage insurance is one of the common themes there, which is actually another bullet point for me later on. Or a HELOC or a second mortgage, or a refinance pay off a HELOC or combine a first and second mortgage. But whatever the case, in some circumstances, switching loan types is a motivator. Number 3, tapping equity. Record levels of equity in this country, while simultaneously having record levels of personal debt, makes this a perfect storm in some senses for people to talk to a mortgage broker like myself and say, Matt, does it make sense for me to take $70,000 in cash out, pay off $70,000 in credit card debts? The payments on this $70,000 in credit card debt is $2,400 a month. It's burying me, swimming upstream. It's really heavy. And so debt consolidation under this, heading of tapping equity or doing a cash out refinance could and will be a reason for people to cash out. Again, it's very personalized. You want to have the conversation. Does it make sense? Maybe you owe $600,000 and you've got a 2.99% interest rate. Cash out refinance to pull $70,000 and cash out does not make sense. Second loan, HELOC, something that leaves that $600,000 at 2.99% alone. But in other cases, you owe $120,000. You're going to pull $80,000 in cash to pay off debt. Your blended rate is going to be better just doing a cash out refinance versus a home equity line at 9 or 10%. So again, personalized advice for personalized situations. Another reason for doing a cash out refinance and tapping equity might be a home improvement. A lot of people have growing families, right? So they're going to do a 400 square foot addition, or they're pulling out cash for other investments. They're investing in a business, they're investing in rental real estate, something of the sort. There's record amounts of home equity. There's plenty of capital equity. You just want to do it responsibly. So again, have the conversation with somebody you like and trust. Next one, shortening your loan term. Now, I had a lot of conversations around this during this last little tick down in interest rates where it made sense for a few of my clients who were 1, 2, 3 years into a 30-year fixed to go ahead and refinance their mortgage. And when they did, they went from a 30-year to a 20-year, taking somebody from a 7% 30-year to a 5.5% 20-year. I was able to essentially give them the same payment than they had on the current loan with 28 years left of it. And so as you can imagine, paying a loan off 8 years sooner in 20 years versus 28 is huge. And when we looked at the interest savings for these clients, it was multi six figures. The figure I remember from one of the clients was $204,000, and that was lower than what the other client going from 28.5 years to 20 years was getting. So you can save all kinds of money on interest. You can pay it off faster. It doesn't make sense for everybody, but for some people, shortening your loan term is a reason to refinance. Okay, a reason that is happening a lot, unfortunately, is, divorce, buyout, removing a co-borrower. This happens, right? There is no other way to remove co-borrower when husband and wife are both obligated on a mortgage than to refinance it. So this isn't a interest rate driven refinance. This is, we've gone through a divorce. This spouse has been granted the house, and that's their debt associated with house. So we need to refinance that debt in just their name. Get this other spouse off the hook. And I've heard some bad information out there about, this spouse can still do X, Y, and Z, and it's not a terrible idea to still be obligated for this. You don't want to be obligated for a debt that you're not the responsible party paying. Trust me, it seems risky. So divorce, buyout, removing a co-borrower. I'm also seeing some refinances when it comes to homes being passed down. Somebody passes away, a parent passes it down. There might be a refinance because one of the siblings wants to buy out the other 3 siblings and they want to own the asset. And so lots of different cash out refinances due to life happening. Okay, some people are restructuring to improve cash flow, and I've seen it kind of the opposite way of what I talked about earlier, where somebody was going from 28 years to 20. Sometimes people have 14 years left on a mortgage and they're going to refinance, go back to 30 years, lower the payment. It's going to help them during this time of financial strain. And the plan is to sell this thing in 5 or 7 years. And so they're not going to have it paid off anyway. They're going to just lower the payment for these few years that they have, some financial strain, and it's going to help them out. And there's all kinds of different structures and stuff that makes sense. And it's, again, everybody's situation's different. Last but not least, eliminating mortgage insurance. This happens where somebody buys with an FHA loan or they buy with a conventional loan with less than 20% down. And you have to be able to do the math in these cases. And you have to be able to say, does it make sense? I wrote a lot of FHA loans where the FHA loan plus the mortgage insurance was still a way better payment than any conventional refi without mortgage insurance. If you go from 4% to 5.75 and that 4% FHA loan has 0.55% mortgage insurance premium attached to it, like that's still a lower payment and less out of pocket than a 5.75 conventional with no mortgage insurance. So you could be eliminating mortgage insurance. The house is appreciated, but you got to look at it. It's not something that makes sense for everybody. So real quick, just as a recap, there's 7 different things here that I discussed. Lowering your interest rate, switching your loan types, tapping equity, doing a cash out refinance, shortening your loan term, a divorce, a buyout. And I also mentioned, there might be somebody that passed on a house, restructuring your loan to improve your cash flow. Seeing this happen sometimes on investment properties where, they're looking to improve cash flow. They might have had some, expenses that came up on that property. Lastly, eliminating mortgage insurance. So those 7, there's more. Those are the ones that I thought of that come up most often. In closing, I want to say real quick, I watched another video I think it was a Dave Ramsey video where he broke down actually pretty eloquently break-even analysis. That is something that even if you're going from a 15 to a 30 or a 30 to a 15, no matter what you're doing, there's a way to kind of calculate your break-even analysis by just saying, I'm going from 7 to 5.5. 1.5% of this $500,000 loan amount is $7,500. How much in expenses did I incur, whether it got rolled into the new loan or not? And then you divide it by how much you're saving. And if it cost you $10,000 and you're saving $7,500 a month, that's roughly 1 1/3 years, right? You might take the $7,500 savings and say, what's that divided by 12? A lot of people want to know their monthly savings. Okay, we're saving $625 a month. Well, let's look at lender costs, title fees, different things. Don't look at prepaid tax and insurance. Just look at the true costs that went into the loan. And maybe that is $8,952. I'm throwing out a random number. I'm dividing it by 625 because that's how much I'm saving per month. And this loan is going to break even in 14 months. Dave Ramsey said under 36-month break even made sense. I know some colleagues, people that I'm around that say it's got to be less than 24 months. Really, the choice is yours. And I encourage you, have the conversation. I have been doing this a long time and I've done a lot of refinance. And when I do refinance, generally speaking, I try to go into it without assuming anything. I see someone's mortgage statement. Oh my gosh, it makes all the sense in the world. They should do X, Y, and Z. And you talk to them on the phone. They've got circumstances that are unique to them. And they've got goals and they've got things that they'd want that I might not have thought about. And so as a consumer, what you have to do is talk to somebody who will listen and based on their experience, give you great advice. Go to greatmortgagebroker.com, connect with me and my team. We'd be more than happy to help. If there's one thing I know we do well, it's refinance. Thanks for watching. Hope this helped you. Bye-bye.